Somewhere in your family, there's probably a version of this story. A grandmother who kept a few gold coins sewn into a coat lining. A father who bought a plain gold ring just in case, and never explained in case of what. A small drawer somewhere in a house you grew up in holding a thin gold chain nobody wears, and nobody sells either. You've probably smiled at that instinct, and maybe rolled your eyes a little. It feels old-fashioned, a little superstitious even. Money is supposed to be numbers in an app now, not metal hidden in a drawer. Except right now, in central bank vaults across the planet, the most powerful financial institutions in the world are doing exactly what your grandmother did, quietly, deliberately, at a scale that has never happened before in modern history. And here's the part that should genuinely surprise you. It isn't because gold is a great investment. It's because of something far more uncomfortable than that.
Hey, welcome to Opulencia. I break down the economy, money, and the systems most of us were never actually taught to understand, using real numbers instead of guesswork. If today's the video that makes something click for you, the subscribe button is right there, and it costs nothing but genuinely helps this channel keep going. So here's the real question we need to answer. Why would anyone, let alone the most sophisticated financial institutions on Earth, buy an asset that pays no interest, produces no income, and just sits there in a vault? The easy answer is because the price is going up. But that explanation is backwards. Gold isn't rising because people suddenly fell in love with a shiny metal. Gold is rising because people, and increasingly entire governments, are losing a little bit of trust in something else.
Think of it like an insurance policy nobody actually wants to need. You don't buy fire insurance because you expect your house to burn down next week. You buy it because you can't completely rule it out, and the cost of being wrong without it is too painful to risk. You pay a small, steady cost every year for a policy you hope you'll never actually need, precisely because the alternative, being caught with nothing when disaster hits, is unacceptable. Nobody calls that a wasted purchase just because the house never burns down. That was never the point of the policy. Gold works the same way, except the policyholders are entire countries. Gold doesn't depend on any single government's promise to pay you back. It doesn't depend on any one currency staying strong relative to others. For roughly 5,000 years, across nearly every civilization that has ever used money, gold has been treated as real, durable value when everything else felt uncertain. That track record is the entire point. Nobody has to trust a particular institution to trust a bar of gold.
So, let's walk through what actually happened, step by step, because the sequence matters more than any single headline. Through 2025, gold didn't just rise. It tore through every psychological ceiling analysts had quietly agreed on. It broke through $3,000 an ounce, then $4,000. Then, in late January of 2026, it hit an intraday peak just under $5,600 an ounce. Sit with that for a second. In a single year, gold gained somewhere around 65%. Numbers that large don't come from jewelry demand or wedding season. They come from something far more structural, happening several layers beneath the price chart. Here's layer one. Central banks around the world, not one country's central bank, but dozens of them across different continents, have been buying gold at a pace of roughly 60 tons a month through 2026. Before 2022, the historical average sat closer to 17 tons a month. That isn't a small shift. That's more than a threefold increase, sustained for years, not months.
Ask yourself why a central bank staffed by trained economists would choose to hoard a metal that earns exactly 0% interest. The honest answer is this. A growing number of countries have quietly decided they don't want to hold all of their reserves in any single nation's currency anymore. When confidence in one currency wavers, even slightly, institutions managing billions don't wait around to find out whether their concerns were justified. They diversify early, and gold remains the oldest, most universally recognized place in the world to put that diversification because it isn't any single country's liability. Here's layer two.
Central banks weren't buying alone. In 2025, gold-backed investment funds pulled in a record $89 billion from everyday and institutional investors combined. Total holdings inside those funds grew past 4,000 tons globally, an all-time high. Two entirely different groups, central banks with no interest in short-term profit and investors chasing returns, were pulling in the exact same direction at the exact same time. That kind of alignment doesn't happen by accident. Now, you might be thinking this is really just a story about one recent conflict spooking markets, and that once that specific headline fades, the whole trend fades with it. It's a fair assumption, and it's only partly right. A regional conflict can absolutely spike oil prices within days, and higher oil prices do ripple into inflation fears, which do push more money toward gold in the short term. That's real, and it's happened again recently. But the central bank buying didn't start with any single conflict, and it isn't concentrated in one part of the world either. It's been building steadily for years, across central banks on nearly every continent, most of it driven by a slower, quieter motivation, a growing reluctance to keep so many reserves tied to any one currency's fate. A war can accelerate that instinct for a few weeks. It didn't create it, and it won't be the thing that ends it either. Now, here's the part that genuinely trips people up, and it's worth slowing down for. If you check the gold price today, it is not sitting at that record high anymore. Right now, it's trading closer to $4,000 an ounce, noticeably down from January's peak. So which is it? Is gold surging or is gold falling? Honestly, both at the same time, and understanding why is probably the single most useful lesson in this entire video. Short-term price swings, up 18% one month, down 12% the next, mostly happen because of trading activity, interest rate expectations, and headlines. That's noise. It's real, but it's not the story. The trend sits underneath the noise. Even after that pullback from the January peak, gold is still worth roughly 20% more than it was exactly 1 year ago. And the central banks buying around 60 tons a month didn't quietly stop the moment the price dipped. Structural buying, the slow, patient accumulation by institutions thinking in years rather than days, keeps happening in the background, largely indifferent to what the chart looks like on any given Tuesday. That's the actual difference between a headline and a trend, and it's a distinction worth carrying into every other financial story you'll ever read. Consider someone like Daniela. She isn't an investor. She doesn't watch markets, doesn't know what a central bank reserve is, and has never once looked at a gold price chart. But over the past year, she's noticed something in her own life. Her paycheck doesn't seem to stretch quite as far as it used to. Prices at the store keep drifting upward in small, frustrating increments, and the news keeps mentioning conflicts in places she couldn't confidently point to on a map, conflicts that somehow always connect back to oil, which somehow always connects back to prices at home. She can't fully explain the mechanism, she just feels the outcome of it. Recently, almost on instinct, she found herself looking up whether it's worth buying a small gold coin, not because she read a report on central bank reserves, but because the idea of holding something that doesn't depend on any government's promise suddenly felt oddly comforting. She didn't know she was echoing a decision being made in vaults on nearly every continent, just at a very different scale. And that quiet background unease, that sense that money itself might not be as stable as it's supposed to be, is precisely the emotion driving trillions of dollars in decisions she will never personally be part of. The people running central banks feel a version of that same unease. They just happen to have the tools to act on it at the scale of tons instead of ounces tucked into a drawer. Here's the reframe worth actually taking away from all of this. Gold's price isn't really a measurement of gold at all. It's a measurement of trust in currencies, in governments, and in the stability of the entire financial system that quietly prices everything else you own, from your savings account to your salary. When that number climbs sharply, it isn't really telling you gold is valuable. It's telling you that some of the most informed financial actors on the planet are actively hedging against uncertainty they can see building well before it shows up in the evening news. Once you understand it that way, a record gold price stops being a confusing, isolated headline and becomes something genuinely useful, a real-time signal for reading the room the global economy is currently sitting in.
Now, to be clear, this video is not a suggestion to run out and buy gold. That's a decision with real trade-offs attached to it. No income while you hold it, no interest, price swings shop enough to matter over a short window, and whether it makes sense at all depends entirely on your own financial situation, which no 10-minute video can responsibly assess for you.
The actual takeaway here is simpler, and it costs you nothing to use. The next time you see a headline about a record gold price, you don't have to feel confused or feel like you missed some obvious opportunity. You now know exactly what that number is actually measuring underneath the surface, how much trust the world currently has left in its own currencies and institutions. That understanding is worth far more to you than the price on any chart. It also changes how the rest of the economic news should land on you. A record gold price sitting next to a headline about a currency weakening, or a central bank meeting, or a new round of tension somewhere in the world isn't three unrelated stories. It's usually one story told from three different angles, and gold is simply the angle that happens to show up as a single, easy-to-track number. So think back to that drawer, the coins sewn into a coat lining, the ring bought just in case, with the case never quite specified out loud. It turns out that instinct was never old-fashioned at all. It was just early. The rest of the world's money is only now catching up to something your grandmother already understood without a single economics degree, that when everything else starts to feel uncertain, people, and eventually entire nations, reach for the one thing that has quietly held its value across every currency, every government, and every crisis in recorded human history. She just never needed a boardroom to figure that out.